When we talk of Provident Fund, basically it means that at the time of retirement or exit, here you will basically get 100%. You could be in a situation where now you are in your fourth company and all the former employers had a pension or were putting something aside for you in form of a pension. So the question comes, how do you consolidate all those pensions now that you have left the former employers, right? We come down here and do a form we call exit form. Exit form. We fill in an exit form for each company. This exit form we shall issue, it's a form of instruction to each of these employers.
Hi everyone, I hope this video finds you well. My name is Martin. In case you're here for the first time, since in what insurance, we do civic education as well as reviews on insurance, especially within the Kenyan market. Now today, we want to respond to Evelyn Othiambo. Ulikuwa umetuma swali kuhusu annuities and I want to read your question as it is. Thank you very much for this clear explanation of annuities. Can you also discuss how one can consolidate or move their provident pension funds to one insurer when they have two provident pension accounts? In addition, could you also do a video on the bonus that was given by each insurer for 2024? So for today, we want to do that for a transfer in provident funds. I want you to at least give us a background kwa wenye maybe hawako wameona hii ya annuities.
Yes.
Maybe we start from there.
All right.
What an annuity is, a provident fund.
Okay.
All this, yes. And
okay.
Then now we can look at how to consolidate the provident fund.
All right. Sawa. So thank you guys for reminding us. Yeah. And thank you to, is it Evelyn?
Evelyn Othiambo.
Yes. So we are delighted always to give you content that makes sense to you, that gives you value. Yeah, so I want us to discuss what's the difference between annuity and IDD. At the same time, we can also look at the best way to consolidate your past pensions from former employers, because I believe you could have possibly worked in 2-3 former employers who had pensions, and most likely you left your pension with them. So we shall also show you how you can put all of them together so that you can have some control, right? I want to be very, very brief. So when we talk of IDD and annuity, it is always important to know the genesis, or where does it really start, so that we can now choose, or the employee can choose which option to choose once they do retire. So basically what you'll find is that at the retirement point, majority of us gets a lump sum amount. Yeah, and this lump sum amount, you actually don't have any option of cashing out. Yeah, what you are told or what you are advised is to choose an insurance of your liking on where to transfer this fund. So at that point, that is where you are given at least an option of choosing what kind of a scheme you would want to have. And basically we have IDD, or what can income drawdown, and annuity. So when you talk of income drawdown, what we are basically saying is that this is an option you choose, that you select a certain period, minimum being 10 years, that you give away control over this fund to an insurance company. And once the 10-year period lapses, whatever is left you are given as a lump sum, which you can also choose to extend or to take up another cover, same IDD, or you can choose to change to what we call annuity. But so that you have a basic understanding of what is the difference. So when we talk of annuity, we are saying that you take an insurance plan. Yeah, it's an insurance plan you take that gives you monthly income until you die. That is what we call annuity. In this case, you bring on your lump sum. Unlike the conventional insurance policy, where instead of giving insurance company a lump sum, you give them bit by bit. So annuity is actually a reverse of a normal insurance policy. Here you give them a lump sum, and then they will be giving you small bits of monthly income until that time comes. Now, when we talk of IDD, when we talk of IDD, this one you have for annuity. For annuity, you give or you transfer all rights to an insurance company until death. But this one, you choose a specific period, let's say 10 years, 15 years, 20 years, 25 years. You give away control of your fund to an insurance company for a specific period. Could be 10, 15, 20 or 25. Whatever would be left after that time is lapsed, you get the balance. So why it is important to choose, and you also allowed to do a hybrid. You can have both IDD and annuity at the same time. So for IDD, sometimes you may find that annuity is giving you more than IDD. Other times you may find that IDD is giving you more than annuity. The main reason is two. Number one, the period you select. Because both annuity and IDD, you will have to select a period. For annuity, you select a period. You select this period for the purposes of your dependent or the beneficiary. You can say, I want to have an annuity of, let's say, 5, you could choose a period of 5 years, 10 years, 15 years, right? But that period does not really affect you as the owner of the annuity. It only affects the beneficiary. For annuity, we said it's payment for life, but you'll have to choose for how long would you like your beneficiary to enjoy. So let's say you took a policy or an annuity of 15 years, or let's say even 10 years. If you choose an annuity of 10 years, that means that for you as an individual, you shall get monthly payout for life. But if death happens at the 7th year, what really happens is that your beneficiary only gets these benefits for 3 years. If you choose 10 years, let's say for example the same period, and you die at the 11th year, your beneficiary gets 0. I hope that on that point we are together. So what is advisable is you take the maximum. The maximum period for a beneficiary under annuity is usually 20 years. So we would advise you to take the maximum 20 years. Now, when we talk of IDD, we are talking of something entirely different. You also have a chance to choose your beneficiary, and you can also choose how long. For example, you could say, I want an income drawdown that ends at the 10th year. If you happen to die at the 7th year, the beneficiary here gets a lump sum amount immediately. or whatever is left, the beneficiary is given. What really guides you on what option to choose at the time of retirement is the amount of money you have. If you have more, let's say you have 10 million, you have 15 million, you can actually do a hybrid. By hybrid, I mean you can say, I want to put like 10 million under my annuity and 5 million under my income drawdown. This strikes a balance of growth at the same time lifetime guarantee. If you choose to have let's say annuity alone, sometimes it might become tricky. Let's say you choose an annuity term of let's say 5 years. Unfortunately, you die at the 3rd year. If you are not well advised, because there are a lot of other factors that insurance looks into before they give you a quote. Like for example, they tell you, do you want this annuity to be increasing per year? That is one factor. Number 2, do you want to give your beneficiary anything? So that one makes your cover. Sometimes it gives you more, some other times it gives you less, depending with what you choose. That is why we advise you. It's always good to have a sit down with someone with the knowledge of annuities and the IDD, or basically this kind of schemes, so that you don't make a bad decision. Yeah. So I hope that answers you why sometimes you find that IDD gives you a higher benefit or payout compared to an annuity. Yeah, there are a number of factors. Number 1 is the term you have chosen. How long would your beneficiary benefit? Number 2 is on the question of escalation, or how often do you want, or to what extent do you want your annuity to be increasing sana per year. Also, there are other factors like, do you want to include medical cover? Do you want to include last expense on that? So those are some different factors that may change or may affect the payout, or rather how much you would get per month, depending with the option you choose. Yeah.
So I believe you have at least given us an update.
Yes.
For those who had not watched that video. I think I will also put that link.
Yes.
Your annuity. So if you, maybe there's information you feel we have left out.
Yes.
We have done another video on annuities and pension. So make sure that you go and watch that video.
Yeah.
Now our big question today was on provident funds. So maybe you can also help us understand, what is a provident fund?
Yeah. So for the provident fund, basically this is an option that your employer chooses. And provident fund is opposite of pension scheme. So basically, this being your employer, let me use this space here so that we can understand. So this is your employer. So for your employer, if he wants to encourage his members of staff, he can choose to give them what we call pension. Yeah, at this point, the HR here will have to decide what type of scheme his people would greatly benefit from. He chooses either what we call provident fund, or what we call the pension. When we talk of provident fund, basically it means that at the time of retirement or exit, here you will basically get 100%. Under pension scheme, here you will get 1/3 of your total, and 2/3 you are advised to either buy what we call, what we've just discussed, either a annuity or income drawdown. So with these 2/3, that is what you choose.
You don't have an option.
You don't have an option. Actually, this one you can't cash out. This one is what you get as a lump sum, and what we advise you, instead of, because sometimes you find that you are tempted to spend this money, we advise you, before you think of what to do, first of all, you can put this money under what you call money market fund. And then if you want to increase the payout of your either annuity or provident fund, you can actually top up here. This one that can be, you can also top it up onto what is left here, so that you can have at least a reasonable amount at the end of the month. So basically that is the major difference.
So maybe let me ask a question.
Yes.
Now we're talking about money that you have contributed for a number of years.
Yes.
So who makes a decision where to put that money? Is it a one-man decision, or because what I see with a provident fund, the employee has the advantage of getting 100%.
Yes.
Na kujipanga na hiyo pesa. For pension, you only have access to a third.
Yeah.
And then to that, you have been given two options, IDD or annuity.
Yes.
So who makes this decision of provident or pension?
Okay. So HR, as I've said, makes the decision depending on possibly the past history of his employees and the behavior he has observed. At the same time, you know, there is what we call the standard in a certain industry, or how they do their things. Yeah, for example, you may find that a religious sector, the majority of them opts for provident fund. But in the same industry, there are other churches that chooses pension, because they understand that you having a lump sum amount, sometimes it can, you know, money comes with emotions, and we understand what happens when you are emotional. You may spend the entire amount on possibly something that doesn't really make a lot of I don't want to say a lot of sense, but something that doesn't have a long-term consequence. But when you talk of IDD and annuity, remember here you have been given, let's say your HR chose a pension scheme for you, so you get a that as a lump sum, but to that you are directed to take either annuity or IDD. That decision is purely on you. It's not on the HR. And in fact, possibly the only thing that your HR can do is to give you guidance. But on the decision of who or where your pension goes, or your annuity or IDD goes, it's 100% on you. Yeah, so I'll be very categorical. Sometimes you find that HR is very much insisting that you must take this money to this particular insurance company. But what I can advise you is take your time. The money is yours, and in fact, the moment umeachana na umefika 60, now you are on your own. If something happens, sometimes you find that your former employees don't really even care what is going on in your life, right? So the question was, yes,
how do you consolidate the provident fund?
Yeah.
So I don't know whether that question will, okay, now that a provident fund you get 100%. So how do we now come to the question of transferring provident fund, or the question was supposed to be pension?
What, from my understanding, it's not really provident. You know, you could be at the point of contribution, you could possibly shift jobs. Unatoka this company, mlikuwa na hiyo pension scheme, then you go to another company B. You get? And also for them, they were contributing a pension for you. Whether it's pension or provident fund doesn't really matter. But the fact is, you could be having you could be in a situation where now you are in your fourth company, and all the former all the former employers had a pension or were putting something aside for you in form of a pension. So the question comes, how do you consolidate all those pensions now that you have left the former employers, right? So that is how it is applicable. You get? Yeah, so again, let me use this to show you how you can be able to consolidate all those pensions into one so that you have 100% control of this fund. So let's say this is you here. This is you here, and then you have gone to company A. This company was putting pension, maybe let's say in Jubilee. Then you move from company A and you go to company B. This company also had pension and they were putting their money in Zamara. Then you go to company C, which was putting money in, let's say where? ICA. And now you are in the company D, which is possibly putting money in under India. I hope that illustration is clear. So how you consolidate all this, because you no longer work in them, it is very easy. And I must tell you this. You know, the danger of leaving this pension with your former employers is, number one, if they go under or they go bankrupt, we understand that it becomes very, very hard for you to follow up. If they possibly move their market from Kenya maybe to another country, or if they go bankrupt, it becomes very, very hard for you. Number two is if let's say something like death happened, you know, your beneficiaries or your dependents will not really bother to go to your past employers. They will only go to your immediate employer, whereby you find that all these pensions go straight, if they are unclaimed for at least 2 years, they are put under unclaimed financial asset offer. Yeah, so that is one of the dangers. Number three is, even if you wait until 50, maybe or at the time of retirement, and you had not consolidated all these funds, what will happen is that you will be forced to go back to them. You get? So the easiest way is to do this. You first of all create what you call a IPP, individual pension plan. This gives you control of all your past pension, because you can be able to consolidate them under this one basket, and you can be having one statement, single statement, to look at the performance of your pension. Now the question that comes is, how do you do it? So it's very easy. The very first thing is we consolidate the required documents. And the required document here is that, number one, we do an application form. We fill in an application form. We attach your ID and we attach your KRA PIN certificate. Those three documents are very, very easy to do. Once we do this, we share instruction. Application actually is an application goes to an insurance company, and we generate what we call an account number. Now once we generate this account number, we come down here and do a form we call exit form. We fill in an exit form for each company. This exit form we shall issue, it's a form of instruction to each of these employers. We don't go to the insurance companies themselves or the providers themselves. If you are working under company A, so we issue them within an instruction telling them that you want to withdraw your pension fund. So we share this exit form to each of these companies. Then these companies, they issue instruction to their providers. Employers issues instruction to the pension providers. Yeah, what happens thereafter? Because company A sends its instruction to Jubilee, company B issues instruction to Zamara, C issues instruction to ICA, and company D issues instruction to Kenindia. So all these, they send money, they send all those, we call them provision for, we would call them statements. So all these insurance companies, they share that money to the IPP account. Let's say you opened an IPP account with Britam. So all of them will share, will send these monies to this specific company under, remember we had created an account here. So they will send straight to that account. Once the money reflects, what happens thereafter is that you as the owner of the account, of the IPP account, is notified. And you are told that the money has been credited into your account and now the money is ready for investments. From there, it becomes very, very easy. You are assisted to open an application or rather a mobile app so that you can be able to monitor and track how your money is being invested and what is the balance. The good thing with IPP is that you can wake up at 2 p.m. at night and look at your balance and see how your money is being invested. Yeah.
A question.
Yes.
Quick one. For normal pension,
yeah,
you are not allowed to cash out.
Okay, this one is very different. Remember, here you are still working. You have not yet exited, or you have not.
What about for a person who has moved to now self-employment? Now you want to consolidate your pension plan.
Yes.
You have now an IPP.
Yes.
Is it going to wait for the period normal pension does?
Yeah.
For you to access now the third, and now that to that you buy the annuities and
yeah, it's a very good question. You have asked whether now that you have opened an IPP account, can you be allowed to cash out? Basically, what you'll find is that at the time of moving these pension funds to your IPP, there is a small allowance of you cashing out at least 50%, but 50% must strictly go to that account, IPP account. Now, once you consolidate them, the only unfortunate thing is that this one can only be cashed out at the point of 50 years. Once you hit 50, that is the only time you are now allowed to withdraw from this IPP account.
100%?
100% now that you have reached the minimum retirement age, which is currently 50 years. But before that, if you try to withdraw, but although you are allowed to withdraw on just 3 conditions. One, if you move from Kenya to another country, that is one of the conditions. Number 2, if you are declared permanently disabled. And finally, if you are critically ill, that is the only other time you are allowed to cash out 100%
before the age of 50.
Before the age of 50. And those who have tried to cash out before, we know what happens. You know, it's not really cast on stone that you can never do that. But if you try to do that, the tax that your money will be subjected to, it's too hefty. You may not even find the reason of working, having possibly worked for 20 years, and you are giving away maybe 50% of your money. That's too painful. So what I would advise you to do is do not actually have the urgency of even withdrawing the 50%, because that money would be better utilized when you don't have a lot of energy. Let's say when you are 55, 60, that's the most appropriate time to withdraw this money. Let even the 50% you ought to have withdrawn rather, let it stay. It will grow, and now it will grow with a certain percentage depending with which institution you have put your money to. And for example, for the past 10 years, we've seen companies declaring quite a competitive interest rate. The one that I can remember is for last year. Actually, the company that issued the highest last year was Sanlam, which issued 15%. Yeah, 15%. But what we are not sure, and I don't want to mislead our viewers, is we don't understand the management fee. And you will find that some companies have what we call they are divided. There are those who do fund management, and there are those who are fund administrator. There are others that have both institutions linked or inside under one roof, which may significantly reduce the cost of running the scheme. So you may have a very high interest rate declared, but what we don't know is whether they are purely fund managers or fund administrator, and also the trustee. You will find that there are a couple of bodies that are involved in pension. Number one is the administrator. Number two is the fund manager. Number three is the trustees. And number four is what we call what do we call them? The banks, that the custodians. Those are the four bodies, and each body charges something on that pension. So you may find that yes, we have declared a very good rate, but each of these four bodies are taking a small share. So there are other companies that declares net. Once they say we are giving out 10, it's 10 net. Yeah, but basically what you'll find is that companies like Sanlam last year, they issued 15%, yes. You will find Old Mutual, yes, Old Mutual, they declared I think 14. We have Britam, which was that one, which declared around 13%. We have Jubilee, they were up there, but the guiding principle here is not really to look at last year only. Look at the average 10 past years. That one can give you a good highlight on which is the best company to invest your pension in. Are we together, Martin?
We are together. Good. That's so detailed. I didn't even have a question to ask.
Yes. So basically, these matters are best handled when we have a meeting, because you could be having a very specific question, or you could be looking for a very customized plan. That is why we would advise you to reach out to us so that we can either have a meeting, we can have a sit down, we can discuss this. If you find that whatever we are giving you is valuable, you can go with it. If you find that you have someone who can possibly give you something better, we are open to that kind of arrangement so that you get the best deal. Remember, our focus is not really or rather what we are interested so much in is giving you value, and if you get value, you speak or you extend that message to your friends, to your colleagues, so that we can have something that helps us all. We get value as you also get the value.
Let me just highlight it.
Yes.
One of the things I've gotten, the advantage of opening an IPP,
yes,
is one, you have the control of where you want your pension to go.
Good.
As opposed to when you leave your pension with your previous employer, you're not sure whether they have put that money in the best company.
Good.
So even in terms of interest rates, you may not be aware.
The couple actually what you'll find, Martin, is if you leave your pension with your former boss or former employer, there are a lot of challenges. Number one, most likely you didn't leave that company in good blood, so you are kind of you don't really want to have any discussion with them. So what you'll find is they don't really focus on those who left, they focus on those who are present. So whether your pension is having challenges or not, they don't really care. So the easiest way is to call those pensions into one account which you have kind of control. Number two is what we've talked of, you not having control over your fund. Yeah, you don't know how it's performing, or rather, if you even want a statement, believe you, you'll have to go back to them, and you left. So
what value are they getting from hustling for your statement?
so that is what that is why we advise you to call all those into one account. At the same time, things happen. You know, you cannot update your beneficiaries wenye wako kwa pension yenye iko kwa former employer. You can't. So that is another reason to consolidate all your pensions into one. So you get a lot of benefit. Yeah. So you are able to track and see the value your money is actually getting. Yeah.
So this is an urgent call for everyone who has maybe worked in more than one company.
Yes.
It is an urgent call for you to create an IPP like tomorrow.
Like today. Yes.
Get control of your pension.
Yes.
Get to know how your pension is performing. It's your money.
Yeah.
Right.
Good. So we shall put our numbers there, so that if you have something that you would like to understand in a better way, we are open 24 hours, so that we can give you something that you remember us for. Yeah, ours is to give you value, and we definitely we get value by serving you. Yeah, so Martin, don't forget to put our numbers on the screen, so that our viewers can be able to reach us out.
Wonderful. So thank you very much. I hope we have given you value for your time, and the contacts are as well in the description box, so you can also reach us out. We also have a WhatsApp group where you can join for those personal issues. Join the group, and we'll be able to have a easy way of reaching to you.
Yes.
So thank you very much for watching this video to the end, and I hope we gave you value for your time. And until we see you in the next one, God bless you and bye bye.